Welcome, everyone. Thanks for coming to Investing 101 or some basic investing training. My name is Peter Go. I'm excited for you to be here. Thank you for being here. Maybe some of you not even here by choice, but either way, thank you for coming and listening to the recording here. Like I said, my name is Peter Go. Today, we'll be covering some investing basics, and whether you're a student here, just doing this to learn for yourself, or you're somebody from It Makes Sense, here to learn more about investing so that you can help other students. Thanks for coming. A little bit about myself. I did work at It Makes Sense from 2019 to 2020. Enjoyed my time there, learned a lot, was able to help students, and appreciated the opportunity that I had there. Thank you to the students that work there now. I think we're able to help positively impact the student body with money, which is something that sometimes can be neglected. And so what you're doing does help people. So thank you for doing that. And for those of you who are students, great that you're here wanting to learn more about yourself. Money is just part of life, and it's a very important part of life. So if you can if you can retain probably half of this presentation, you'll already be ahead of the game as far as college graduates on the knowledge of investing. So just start sharing my screen here and get us to the presentation. So again, this is what I call Investing 101, but just some basics on investing for college students. So like I said, my name is Peter Go, and a little bit about myself. I did mention that I worked for It Makes Sense from 2019 to 2020. Now currently recording this here at the end of 2020, and I am a finance and economics double major. I'll be graduating at the end of 2020 in December. A little bit about myself. During my time at La Crosse, I was the investment club president, and also interned at Thrivent for a financial planner. After graduation here at the end of 2020, I will be taking a role as a financial planner at Thrivent in West Bend. So it's a little bit about myself, and let's just dive right in. So, I got to ask the question, we're talking about investing and retirement and saving for retirement. Will you be a millionaire by the time that you retire? Maybe you've heard that number before as what you need to retire comfortably, or maybe it seems like such a big number that the average person could never attain this. But another question I have that you may see coming would be, could you afford a Starbucks coffee every day? You may have heard this comparison before, but it's still worth noting. Of course, could you afford a Starbucks coffee every day? Most people probably is going to answer yes to that. And will you become a millionaire at some point in your life? A lot of people don't feel so confident about that. And so the big number that I like to point out here at the start is $4. For most of us, I'm just making the assumption, low 20s here in college. If you're able to put about $4 a day into your investments for retirement, of course, lots of assumptions here, but you should end out with about $1 million when you reach that typical age 65 for retirement. And so just want to put a little perspective into that. Maybe you've heard other things as far as how much you should save per day, but just making some assumptions here, rough numbers. $4 a day can make a huge difference, not only for yourself, but for your potentially future family, and just being able to enjoy the life that you want to live in your retirement. Another thing I want to point out too is that we don't only invest for retirement. It's the most common form, the most common reason that why we invest money, but that's not the only reason. So just want to point that out a little bit, give a little context, and maybe bring it down to, I know as college students, it can seem daunting to think investing for retirement or saving money when we're worried about paying for rent, paying for tuition, all of those sorts of things, when money can be a little bit tighter in college. But it is good to just realize that whatever you're able to do right now, it can make a difference. And if you're able to do that $4 a day, maybe that's a goal that you can either start today or a goal that you can start working up towards, even if it's $1 a day, whatever it is, but just getting started. And we'll get to that a little bit later. But again, quick agenda, what I'll be covering today. So what do I invest in to become a millionaire? Second, strategies to make you a top college investor. How to keep taxes off your investments, which is really important and often overlooked. And then finally, tips for getting started. So another question here for you, what is the most important factor in earning money from your investments? lots of different things that come to mind here, with some of the common ones being, stocks or bonds. Should I invest in Bitcoin? Should I invest in real estate? Should I have a partner? All sorts of different questions on how can I make the most money from my investments. But really the most important factor when talking about earning the most amount of money from your investments is the amount of time that you have. Of course, again, as college students, we likely all have of that on our side compared to the average person or the average working person. And so time is something that's super important. In my own experience, talking with a lot of retirees, this is something that is very common. People bring up regrets that they had is not saving when they were younger, and something that we can try to avoid. Of course, there's certain circumstances where it may not be possible, and I totally understand that, but time is very, very important when it comes to investing, and especially investing for the long term, or more specifically, retirement. So just want to give a quick example, just the power of time. It's one thing to say time is the most important factor, but here's an example of the power of time. So you can feel free to read along with me here. At age 19, Ben decided to invest $2,000 every year for 8 years. He picked an investment that averaged a 12% rate of return. It's a very solid rate of return, maybe a little bit high, but anyways. At age 26, Ben stopped putting money into his investments and put a total of $16,000 during those 8 years that he did invest money. Now, on the other hand, his friend Arthur didn't start investing until age 27. And just like Ben, he put $2,000 into his investment funds every year until he turned 65. So he got the same 12% rate of return as Ben, but invested for 31 more years than Ben did. So in total, Arthur invested $78,000 over 39 years. So again, Ben invested $16,000 over 8 years at age 19, and Arthur, starting at 27, invested $78,000 over 39 years. You can probably see where this is going, but if you can see that there, I know it's a little small. Ben is on the left, Arthur on the right. As you see, Ben investing $2,000 every year from 19 to 26, and ending with almost twice as much as Arthur, who, if you remember, put in $78,000 compared to Ben's $16,000. So again, it just shows the power of starting early, and even if it's small amounts, just having that money in your investment account starting to grow for you over time makes a huge difference. Even when you look at age 27, when Ben stopped investing, he already had $30,857, while Arthur had nothing in his account. And so that head start that Ben had proved to be what led to Ben having nearly twice as much money as Arthur. So again, just an example of showing the power of time and the power of the ability of time to grow your money. So maybe we know, okay, we should invest early, but what exactly am I investing in? We say investment funds, or we save for retirement, but what exactly do I invest in? That could be a lot of things. It could be stocks, bonds, mutual funds, ETFs, or other alternative investments. Many of these things I'm sure you've heard of or may even know about, but just to make sure that we're all aware of what different types of investments there are, what their purpose may be, and when might be a time for you to invest in those assets. I'm going to cover a little bit on each of those and when they might make sense a little bit for you. So the first one is stocks. Most of you have heard of stocks or a common stock. Stocks represent a fractional ownership in a company. As you can see there on the picture, that is a actual old physical stock certificate. This is how stocks used to work. Companies would issue stock and they would issue the certificates. People that bought the stocks would receive that certificate, which would then prove that they owned shares of the company. This is no longer the case with everything being done electronically, but even in my time as an intern, I did actually experience working with an older couple who were in their 70s that still did own some physical stock certificates. So it is old, but not extinct at all at this point. And again, the important thing to know is that stocks are a fractional ownership in a company and that they're issued by a company. So if we're talking about Wells Fargo here, when Wells Fargo's owners wanted to raise some money, they may sell part of their ownership of the company. And so let's just say, for example, I don't know Wells Fargo's history, so who knows if this is actually correct, but let's just say those two guys up there own half of Wells Fargo and they need some more money to expand their business. And so instead of going to their own pockets for the money, they want to get money from other people. And so they sell part of their ownership in the company. And then people pay them for that ownership and again, own part of the company. Typically a very small fractional ownership. As individual investors, and especially as college investors, we're probably not owning significant parts of these companies, but that's really irrelevant. The important part is that you're owning part of that company and you then have a right to the profits, your fractional part of the profits for the company. And so stocks are traded on the secondary market. And so initially when you buy a stock, the first person to buy the stock from the company would be buying it from the company directly, and the money goes to the company. But after that, stocks are then traded between investors on stock markets like the New York Stock Exchange. And so that would effectively be you or I. Maybe I own the Wells Fargo stock that I bought, and now you want to buy it 2 years later. So you buy it from me and you give me the money to own the stock. So it is important to know when you're buying stocks, typically you're not buying them from the company. You're generally buying them from another investor. Stocks have provided the greatest historical return when we look over the last 100 or so years. And so they're generally a staple for investment portfolios, especially for long-term investment portfolios. It is important to know that there are risks associated with stocks. You are owning again, fractional part of a company. For example, if we go look at Wells Fargo again, if something happens, or even did happen with Wells Fargo, they did have a bit of a scandal, I believe in around the 2015 or so timeframe, where they had some issues and lost a lot of money in lawsuits and all sorts of other things. So that the value of that company declined, the profits of that company declined, and as an owner, you have risk, because if you're owning that small part of Wells Fargo and that happens, your small part is also going to decline. So there are risks associated with stocks. And with that being said, they have provided the greatest historical growth when we look at the last 100 years. Another one that many of you have heard about, I'm sure, is bonds or fixed income. Bonds are a unit of debt issued by issuers and sold to investors. So what does that mean? The best way to explain that is to give it through an example. Let's say Tesla, they're building a new gigafactory in, I believe it's Austin, Texas, actually. But let's say they do want to build a factory, but they don't have the money to do so. So if they want to borrow money from other people, they can issue bonds, which are somewhat similar to IOUs, where investors give them money and Tesla promises to pay them back. And so while they have the money, they pay a fixed interest rate to the owners of the bond. So again, Tesla needs, let's just say $100 million to build the factory. I'm sure it was more than that, but let's just say Tesla needs $100 million. For easy math, they get 100 investors who all give them $1 million to build this factory. When they do so, they're going to agree to a fixed interest rate that Tesla is going to pay them. So let's just say it's 5%. So each year, Tesla is going to pay them 5% on the $1 million. And so as the investor, you get that 5% on your money each year. And then in addition to that, if it was a 15-year bond, after 15 years, Tesla would then have to pay back the $1 million to each 100 investors. So again, Tesla is getting $100 million from 100 investors. They use it to build the factory. Let's say they are able to make more cars, make more money, and at the end of 15 years, they pay back all of the 100 million back to their investors. And so with bonds, you're giving money with the assumption that you're going to get all of your money back, including interest. You can kind of think of it as you're almost acting as if you're a bank. It's similar to what banks do when they lend money to people for car loans or for homes. And they receive a fixed interest rate, and then eventually they get paid back over the long term. The most important risk to be aware of with bonds is default risk. This can be tied to market risk or risk of the company going down, but slightly differently. So again, if we go to the Tesla example, let's say Tesla doesn't do well, they're not able to sell enough cars, they can't pay the bills, and all of a sudden they go bankrupt. And let's say they just go bankrupt and there's no more Tesla. It's not a company anymore. Well, you have given them $1 million as one of the investors. You may not get your $1 million back. because the company no longer exists and they were unable to pay you back. And that would be what's called default risk, where you're really, money is being risked because the company may default. And so this may sound maybe obvious, but with a company that is more likely to pay back your money, that's going to be a safer investment than a company, Tesla, or a smaller company who may not have the financial capabilities to pay you back. So just for example, if you're going to give money to Disney, or you're going to give money to a mom and pop shop, you're probably going to get your money back from Disney. It's a pretty good chance you're going to get that back. It doesn't seem like Disney's going away anytime soon. So that's default risk. That's something to be aware of as well with bonds. Then mutual funds. Mutual funds are most common in retirement accounts, which we'll get to a little bit later. And mutual funds, you get to think of them as being mutually funded, right in the name. A group of people, a group of investors pool their money together and then have a professional money manager and their team that invests in all sorts of different assets, some of them in stocks or bonds or other assets. And then those money managers charge a fee for the management of that money. It's really a pretty simple investment vehicle. So again, mutual funds, just think of them as mutually funded, pooling money together to go out and buy investments like stocks, bonds, and those sorts of things. It is also important to know that with mutual funds, you're diversified. That's really one of the biggest pro to using a mutual fund, is that with a common stock, you might own one share of Wells Fargo, and if Wells Fargo does poorly, your investment goes down significantly. It can. With mutual funds, you're going to be owning hundreds, if not thousands, of different stocks and bonds. So if one goes down significantly, another one may go up just as much, where you may not even notice that. And so diversification is very important as well, so that you may have heard of don't have all of your eggs in one basket sort of thing. It's the same type of thing. So if one of those companies goes bankrupt, another 2 or 3 might do great to offset the fact that one of them did so poorly. And so mutual funds, one of their biggest pro with them is that because you're able to pool your money, you're able to buy hundreds of thousands of stocks and bonds and be more diversified than you would if you just bought your own stocks and bonds. And also, you do also have a professional money manager and management team managing the money. Exchange traded funds, these are relatively new, started in the 90s, referred to as ETFs. Very similar to mutual funds, they're also diversified across oftentimes thousands of different companies. The primary difference is the way that they're bought and sold. Not to get too technical here, but mutual funds trade once a day at market close. So if you put in a buy order to buy shares in a mutual fund, that won't get processed until the end of the day. Whereas with an ETF, that buys and trades actively while the stock market is open, just like a stock would. So don't want to get too technical into all of that. Really don't need to know, all the different technicality differences between ETFs and mutual funds, but they can also hold different types of investments like stocks, bonds, and all sorts of other things, just like mutual funds can. One thing to note with ETFs is that they do offer lower expense ratios than mutual funds, and so they're typically a cheaper way to become diversified. And just speaking me personally, I prefer ETFs over mutual funds for that reason. They're generally cheaper than mutual funds, meaning that you pay the management team less on an annual basis. And that means that there's less fee drag on your investment funds and they can grow more and grow faster for you. Then quickly touching on some alternative investments. Gold is one of them that's very popular. There's different ways you can invest in gold. One of them being actually owning physical bars of gold. That is very expensive. Won't get into more of that either. But gold is a popular alternative investment. In addition to that, real estate, that you can probably find millions of books out there and articles on why you should invest in real estate. I do think real estate is a very good investment, but it's not for most people. And it's not the same as, generally not the same as investing in stocks and bonds in a passive portfolio. There are ways to do that. Again, if you're interested in learning more about that, you can always reach out to me. I have my contact information at the end. If you have any questions or any of those things, probably should have mentioned this at the beginning, but if you have any questions or thoughts or ideas, anything like that, or resources that you're looking for, feel free to contact me. Or if you have a question, just jot it down and shoot me an email. Happy to answer that. But anyways, on that tangent there, gold, real estate, and then there are also collectibles like art, even sports cards. Recently, that Mike Trout baseball card you see right there sold for a couple $1 million, breaking the record for most expensive sports card ever sold. That's kind of interesting. It seems to be increasing in popularity lately. But those are just a couple alternative investments as well. I'm not going to go in depth into those, but just to be aware of those as well. So that's kind of a wrap on all of the different types of investments, what you could be investing in. Really briefly, just want to go over 2 investing strategies. Again, trying to keep things really simple here. We got target date funds. Target date funds are a type of mutual fund, and is a fund that is set up to manage the money with the intention for you to retire at the time stated in the fund. So what that means is different companies have their own target date funds. Let's say, for example, the Vanguard 2060 target date fund. You may see that. So 2060 refers to when you estimate you'll retire. So that would be in about 40 years from now, from when I'm filming this. So again, if you're college age, maybe 20, 21, 22, you can probably assume you'll retire sometime in your 60s if that's what you're shooting for. And so that investing in that fund is going to automatically rebalance your money over time to start out with more stocks in your portfolio when you're younger, and then decrease the amount of stocks as you get older. And so again, if you remember stocks, there is risk associated with the stocks. So they have greater growth historically, but it is important not to have too much stocks when you get close to retirement, because there are risks that money can decline significantly and could derail your retirement. So that's not something that you want. And target date funds addresses that issue by starting with more stocks and moving to less as you get closer to retirement. So here's a quick graphic right here of the Vanguard target date fund, what they call their glide path. You can see in the blue there are US stocks and the orange international stocks. So when you start out when you're young, they're going to put you in about 90% stocks. And again, stocks have provided the most growth over the long term when compared to bonds. And so we want more of that when we're young, because we can take that risk. As you see, as you approach 40, that number slowly declines and continues to do so all the way until you get up to 75 here, where the chart ends. And on the flip side, you can see bonds start out at just 10%, slowly increase all the way to roughly about 60 to 70% as you get older. So again, just the basics of stocks and bonds to remember is that stocks are more aggressive and there's more risk associated with them, but they have provided greater long-term returns. And so with somebody that has a long time to let their money grow, stocks are a great place to invest. But when we get closer to retirement, we don't want to have all of our money in stocks because we could see a significant market pullback like we saw in March of 2020 with the coronavirus, or 2008 with the financial crisis. A couple quick pros and cons of target date funds. A pro would be that they're very simple, very easy to use. You invest your money in one fund. They manage that for you. You're diversified across hundreds of thousands of companies, and they automatically do the rebalancing and allocation of stocks to bonds for you. And I mentioned the target date fund 2060 for Vanguard. That's the ticker there, VLXVX. If anyone is interested, that would probably be about maybe when you're thinking about retiring, if you're looking at the early 60s. So that's one option. Couple cons associated with target date funds. There is less control because they automatically rebalance it for you. You can't decide how much you want in stocks. They're going to go off the assumption that you're going to retire at the date that you invest your funds in. And so there's less control that you have there. And they are a little bit higher cost than most ETFs or stocks doing it yourself. So there are some costs associated with it, but that would be assumed given that you are having people rebalance the funds automatically for you. So of course there's costs associated with that. That's one strategy that you can use, very simple to use. Another way is a custom built portfolio. This would be obviously requiring much more expertise. Can be cheaper because you're doing it yourself, but on the other hand, it can also be more expensive in the long term if you make significant mistakes that could be avoided if you give up the control and use a target date fund or another strategy. Again, greater risk, and this really isn't for most people. Probably the greater population of college students, it makes more sense to use something like a target date fund. But if you're somebody who has a lot of expertise or wants to really learn a lot about this can be a good way to do it. Investing in more stocks as you're younger and slowly decreasing that as you get closer to retirement. And I want to stress too, this isn't only 2 strategies and that's all there is. There's lots of different strategies. I even had more in here that I wanted to cover, but had to take some out just because just for time reasons. So lots of other investing strategies. I have some more resources at the end, websites you can look at, as well as just reaching out to me. I'd be happy to share some more stuff with you. So we know that we should invest. We know that there are different investment options. We know that there are different investment strategies to help our money grow. But what kind of account should I be opening? This may sound like a simple question, but it's really not so simple. There's lots of different options. There's non-qualified accounts. There's employer-sponsored plans like 401ks and 403bs. Lots of other types of IRAs. The two most important to know are traditional IRAs and Roth IRAs. So really lots of different accounts. But what's the difference between a traditional IRA and a Roth IRA or a non-qualified account? It's important to know when you go to invest because if you want to invest in stocks, you do need to open one of these accounts, and you need to know which account fits you and fits your goals for the money. So first, to start off, looking at non-qualified accounts, these are also called brokerage accounts. There's no tax advantages associated with the non-qualified accounts. We'll cover some of the tax advantages associated with the other accounts. But because there are no tax advantages, there's also the least amount of restrictions, and often the ability to buy pretty much any securities that you'd like. And when I say securities, that includes stocks, bonds, mutual funds, ETFs, etc. You can see Robinhood there on the right. They've burst onto the scene. I believe they started in 2012 or 2013, and is very popular with younger people who are starting to invest. And you can easily open an individual account at Robinhood, start buying stocks, bonds, and ETFs, mutual funds, I believe as well. Not totally certain on that one, but it is a great way to get started and super easy to use. So if you're somebody who wants a little bit more simplicity, Robinhood does a very good job as far as setting up your account. They have good educational stuff that can go beyond just what I'm talking about here today on our brief presentation. So I would check out Robinhood if that's something that's interesting to you. Be aware of the risks associated with it in owning stocks, and try to just go through the educational content, make sure you're making wise decisions with your money. This is your hard-earned money, and you don't want to be losing that. So I highly recommend checking out not only educational things on Robinhood, but as well as other websites before you really get into investing significantly. So you may have heard of 401ks and 403bs. This is a very common retirement account. The names 401k and 403b actually just come from the tax code. So section 401k outlines a 401k plan, and similarly with the 403b, same thing. The primary difference between the 401k and the 403b is the employer that administers the plan. There were previously more differences, but nowadays they're generally very comparable. So if you're working in the private sector, you get a job at Google, Facebook, GE, Boeing, any of those things, a private company, they would be having a 401k if they had one of the two plans. On the other hand, if you are a nurse or working for a nonprofit, you may be in a 403b plan. Like I said, there's really not much of a difference, so that's not a huge deal or something to worry about. What's important about 401ks and 403bs is that they allow an employee to divert a portion of their salary into a long-term investment account. So when you get a pay stub, you may see the taxes taken out. So let's just say, for example, your paycheck is $1,000. That might be the gross number on the top, and it's going to have the taxes that you're paying, and maybe your net paycheck is $750. So with a 401k or 403b, you're actually going to take out more from your paycheck, which may sound counterintuitive, like, why do I want to take more money out of my paycheck? But this isn't going to taxes. This is going to an account in your name that belongs to you. And the reason that it's important to take it out before you receive the money with a 401k or 403b, the reason that they take it out before is because it does not count as income if you put it in your 401k. So again, don't want to get into the tax, too deep into the tax side of things. Not here to give you tax advice, of course, but by contributing to a 401k, for example, easy math here, you make $100,000. So that might be the top number for the year, $100,000. And then you contribute $10,000 to your 401k. When you go out to fill out your tax return, rather than putting your $100,000 as your salary for the year, it will actually be $90,000. And so you're not taxed on that $10,000. The government almost acts as if you didn't make that $10,000 because it went straight to your 401k or 403b. And that's their way of trying to nudge us into saving more for retirement in our 401ks by providing tax benefits. So that is important to know for 401ks. The other thing to know is whether your employer has a match. Many companies have what's called an employer match. Sometimes that can be usually between 1% and 5%. A company will match. So if you put 5% of your salary in and your company matches 5%, then if you put 5%, they put 5% in right for you as well. And that's a pretty big deal when you think about it. Your money is being doubled instantly when you put it in. So if you do have an employer match, that's really the first place you're going to want to invest because you're doubling your money instantly by your employer contributing to your account. One thing to know too is that it is less flexible with your money in your 401k and 403b as an individual account because this money is for retirement. For the most part, you're going to need to leave this money into your account until 59 and a half, which may sound daunting or like a really long time. But again, it's meant for retirement. And so generally we want to leave that in until 59 and a half or you'll be paying penalties. All right, individual retirement accounts or IRAs. There's lots of different kinds, SEP IRAs, simple IRAs, but two main types you should know about are traditional IRAs and a Roth IRA. So just gonna cover those two today. So traditional IRA and Roth IRA, a couple similarities and differences between the two accounts. One thing that is the same between them is the contribution limit. So each year the IRS releases how much you can contribute to an account. For some of you that may not be an issue. For 2020, that's $6,000. So it's about $500, or that is $500 per month that you can. That's the very most you can do. And that's an aggregate number. So you can only contribute $6,000 combined between the two accounts. So if you put $6,000 in your Roth, you can't put anything in your traditional IRA. Also, the deadlines are the same. I don't want to get too down into the weeds here, but you can contribute to a Roth IRA up until April 15th of the following year. So that's really only important for people who are going to be maxing their Roths or their traditional IRA for that $6,000. If you're not doing that, then generally if you contributed into 2019, you can just put it as a 2019 contribution. Now the biggest difference between a traditional IRA and a Roth IRA is going to be the tax treatment. And so with the traditional IRA, it's taxed very similarly to a 401k, where when you put the money in, when you file your taxes, it's as if you didn't make that income. And again, that's the government kind of nudging you to save more for retirement. And so you get a tax benefit up front because you don't pay any taxes on that income. Now, that may sound a little too good to be true because as we know, money tends to be taxed here in the US and there's really no such thing as money that is not taxed at some point. And so when you put the money in, you get a tax benefit. And later on, when you take the money out, you do have to pay taxes on that money. So you do later on have to pay the taxes, excuse me, but you do get the tax break up front with the traditional IRA. With a Roth IRA, it's kind of flipped. So when you put the money into your Roth IRA, you don't get any tax benefits. If you make 100, contribute 6,000, you're still paying taxes on the full 100,000 that you made. No tax benefits when you put it in. But with the Roth IRA, when you take the money out in retirement, you don't pay any taxes on it at all. So that's really important. It's a powerful tool, a powerful account that you can use to get money that is tax-free when you take it out for retirement. One thing to note too is that with 401ks, it's becoming more popular to have Roth 401k options. So it's also good to know if a Roth 401k is an option, and that again relates to the tax treatment between a traditional IRA and a Roth IRA. There are income limitations. If you make a certain amount, that changes a little bit each year. If you make more than the income limit, you may not be eligible to contribute to a traditional IRA or a Roth IRA. Not going to go too much into that. I will just say that it's well past it's in the six figures. So generally for most college students, probably don't have to worry about that. If you do, great, good for you. But it's well over 100,000. So just be aware of that down the road. And then another important thing is early withdrawals. With a Roth IRA, you're able to access what you contributed without any penalties. So again, if we go to the $100,000 that you made, you contributed $6,000 in a year, and then 2 years later, that money is now worth, let's say $8,000, and you need some money, you can take out what you originally put in, that $6,000, and you can take that out without any penalties. But if you do tap into those earnings of the $2,000 that you earned, you would pay some penalties on that. And so otherwise you need to leave the earnings in until 59 and a half, without paying penalties. And with a traditional IRA, it's less flexible. Once you put the money into a traditional IRA, once you put the money in a traditional IRA, you can't access that money till 59 and a half, unless under certain circumstances, which are few and far between. And so generally, plan to leave that money till 59 and a half, or else you'll be paying a pretty steep penalty. So just threw a lot at you there for different types of accounts. I know there's a lot to mull over, but what account is best for you? First question I would ask is, does your employer have an employee-sponsored plan? For many of us, we're still in school. Even if we had an internship, maybe we had a 401k option. Might not make sense just because we're only going to possibly be there for a couple of months. But when you do graduate, it is really important to get that 401k information if they do have that. Determine if you are eligible, what kind of match there is, if they have a Roth 401k, just making sure that you're talking with your HR department to understand your retirement plan, because it is really important, especially when we talk about setting up a 401k at 23 and you may be at that company for years, decades. That's really important to understand your plan and what's best for you. The other question you should be asking yourself is, what is the purpose or time frame for this money? You may have realized that with retirement accounts, you generally have to wait until 59 and a half to access that. That's generally how it is. On the other hand, if you have an individual brokerage account, no tax benefits for it, but you can also access that money whenever you need. So you need to balance those tax benefits along with the liquidity or the access to the money. So if you're saving for retirement and you're not going to touch that, then it might be worth getting those tax benefits, putting it in your Roth IRA or 401k. But if you're saying, I'm going to put this money, I want to invest it, but I might need it for a car 5 years down the road. If I do, I don't want to pay penalties. It might make more sense to invest it in a brokerage account. And I do want to note with the brokerage accounts, generally that can be an individual account, but it can also be a joint account down the road as well. So as we wrap up, just some steps to getting started. It's great to know this information. Maybe you took a lot from this, maybe you didn't, maybe you're falling asleep by now and wishing that you weren't forced to watch this video. But either way, just some quick tips on getting started, because it's really all about taking action. Just knowing these things, sure, they can help you, but they can't really get you to your future goals in life and in retirement if you don't really take action on them. So the first thing I would recommend doing is start looking at your budget, or even building a budget if you don't have one, but just see if there's additional money that could be reallocated to investments. The classic example is coffee. It doesn't have to be coffee for everyone. If that's something that's really important to you, that's totally fine. But there's oftentimes places where you can find money in your budget that you wouldn't miss, whatever that is. If it's coffee, if it's fast food, if it's shopping, whatever it is, a lot of times we're able to find some money in our budget that we could be reallocating to investing for the long term and for our future. Second, I'd recommend determining what type of account best fits your needs. So again, feel free to think about, or even reach out to me on the different information that I shared today on the different accounts. There's a lot. I know I threw a lot at you, but do a little bit of research on what type of account makes the most sense for you, because it is important to know, can you access that money? What are the tax benefits for using that account? And then determine what strategy best fits you. Maybe it's just using a target date fund, putting all your money in there. It's diversified. They take care of the allocation into stocks and bonds, and it's super easy. That's what I recommend to most college students, because it's hands off. You put it in there, you don't even have to worry about it. They take care of everything. But determine what that strategy is for you and stick to it. And of course, start. Again, like I mentioned, knowing these things, although it is helpful, it's really all about taking action and starting and implementing some of these things. Once you do start, try to stay consistent and let the money grow. Avoid touching the money if you have to. Of course, there's things that come up, but as best you can, try to let that money grow and let it grow towards building a better future for you down the road. And then finally, be patient and reap the rewards in the future. Again, like I mentioned, talking to a lot of retirees, this is something that a lot of people do regret later on in life, not starting earlier. And it's something that as a college student, a lot of us have the opportunity, maybe it's $5 a month, whatever it is, but we have the opportunity to start right out of college, whatever that is. We're all really, if we think about it in relation to the rest of the world, we do really have it well. And so I do think that we should be responsible stewards with the money that we do have and be able to invest for our future and for the future around us. So I talked a little bit about this, kind of scattered throughout. Always happy to talk. Shoot me an email or even give my office a call. My email there, peter.go@thrivent.com. If you have a quick question, feel free to email me. If you're not sure on what account makes sense for you given your circumstances, feel free to reach out. Happy to answer any questions or even hop on a 15-minute call and just be able to help you out, be a resource for you. That's our office phone right there. And I also recommend checking out, doing a little research on yourself, on your own too. Investopedia.com is a very good website. They have lots of, if you're looking for definitions or things like that. NerdWallet, another good resource, even for investing, but also for credit cards and banking and that sort of thing. And then thecollegeinvestor.com, which is, of course, in the name, focused on investing for college students. I recommend, they've got a lot of good resources on that website as well. Lots of other good resources, but those are just a couple that I've used and I recommend. I'm also a huge reader myself. A couple books that I'd recommend for anyone who's interested in this or who just wants to learn more through the book form. My first recommendation would be I Will Teach You to Be Rich. That one is right on the right. You can see in the picture. Really good book, not just on investing, covers all personal finance from credit cards, banking, even some psychological things to investing, financial advisors, all sorts of different things. But I recommend that book. It's not really going to go too in depth where you might get lost or get bored. It is really just applicable stuff. So highly recommend that book. And then for the entrepreneurial type, Rich Dad, Poor Dad, really good book. Highly recommend it. One of my favorites. But it's not as much focused on passive investing for retirement like stocks and bonds, but a little bit more for the entrepreneur type of person. So if that sounds like you or something you're interested in, highly recommend Rich Dad, Poor Dad by Robert Kiyosaki. That's really a business classic. Then two other books, A Random Walk Down Wall Street and The Intelligent Investor. If you're really into technical side of things, The Intelligent Investor is, I believe, 400 to 500 pages long. Not at all for the faint of heart. Not what I would recommend for most people. If you're looking for a first book to read, I highly recommend, again, I Will Teach You to Be Rich. So that's really all I have for you guys today. Happy to be a resource for you. Shoot me an email, peter.go@thrivent.com, or give my office a call. Hope I was able to give you some knowledge and positively impact your financial lives right now and for your future. And thank you for listening.